Welcome to Julius Baer's Moving Markets podcast on Tuesday, the 10th of March, with me, Bernadette, and Anderko. I'm looking forward to catching up on the latest financial markets news with my colleague Mike Rauber this morning. And given the fact that everyone is so focused on oil now, it's great that our head of economics and next generation research, Norbert Rücker, is joining us to share his thinking on the latest developments. But first, let's catch up with the main news from the last 24 hours. Good morning to you, Mike.
Good morning, Bernadette.
So, Mike, we're seeing historic moves in Brent crude oil. It jumped 25% on the open in Asia yesterday to nearly $120 a barrel. But by the day's end, it was trading at $88 a barrel, and that was below Friday's close.
Absolutely. And at one point, it even touched $84 a barrel, Bernadette. So oil prices started dropping on reports G7 official would be ready to draw on reserves, with a meeting expected again today. And President Macron announced a joint mission with allies to ensure free passage through the Strait of Hormuz. All of this eased the worst fears during European trading hours. That meant the Euro stocks opened nearly 3% lower, but in the end it closed down only 0.6%.
And then, of course, late in the day, the US president came out with a surprise statement, didn't he?
Indeed, President Trump said he thinks the war against Iran is very complete, and that Washington was very far ahead of his initial 4 to 5 week estimated time frame. He even hinted at reducing sanctions on Russian oil. So did Trump do this by his now classic taco move? Trump always chickens out as oil prices jumped, or is it just a deception strategy? I guess only time will tell. The lingering uncertainty means that oil is at $93 a barrel when I last looked.
And so, of course, markets in the US shifted back into risk-on mode, with equities rebounding, volatility falling, and safe haven flows reversing.
Absolutely. So the S&P 500 rose as much as 1%, having earlier fallen more than 1.5% at the open. The Nasdaq up 1.4%, and the cyclical small-cap Russell 2000 up 1.1%, posted even stronger recoveries. The VIX index, Wall Street's fear gauge, fell to 25 points after peaking at 35 points earlier.
And what did we see in other asset classes, Mike?
A longer-dated government bond yield surrendered most of their earlier gains. The US 10-year yield fell actually 4 basis points to 4.1% after touching 4.21%. Now, this is as inflation concerns eased with lower oil prices. The Bloomberg dollar index dropped nearly 1% from peak to trough as safe haven flows reversed. Bitcoin and silver, both more cyclical, also rose. Gold, meanwhile, it was little changed, now near $5,200 an ounce. And you know, Bernadette, all this underscores how unpredictable political, geopolitical markets can be. And it also highlights the need for a resilient asset allocation that can absorb external shocks.
All right, turning to economic data releases in the US, the monthly New York Fed survey reinforced Friday's weak labour market report. Can you give us a bit more detail there?
So respondents reported lower chances of finding a new job within 3 months if they lost their current one. Expectations of quitting fell to just under 16%. That's the lowest level since 2013. The perceived risk of job loss over the next year declined to 14%. That's the lowest since November. In short, Bernadette, labor market turnover remains low, indicating that the US job market, normally highly flexible, is struggling to absorb shocks.
Yeah, we've got European equity futures in the green this morning, tracking Wall Street. Asian markets also higher, led by Korea, up 6% today as technology shares are rallying. And we've also seen some strong corporate news out of the region, haven't we?
Absolutely. So Tencent is up more than 6%. Its WorkBuddy AI agent, which manages and executes tasks for users, could mark a shift in China from chat AI to execution AI, according to one analyst. Cattle, the world's largest battery producer listed in Hong Kong, gained more than 8% on strong earnings. And Taiwan Semiconductor reported robust sales up 30% in the first 2 months of the year.
And Mike, we had some interesting data out about the Chinese economy. Can you tell us a bit more, please?
Yeah, it's on export and imports. So Chinese exports rose almost 22% in the first 2 months of the year, far above expectations. Imports increased nearly 20%. Now that means a record $214 billion trade surplus. And as a sign that India is also becoming an export hub, Apple makes now a quarter of its iconic iPhones in the country. In Japan, Q4 GDP reported today showed growth of 1.3% on the year, beating forecasts and showing the country's economy is gaining traction. But household spending, it fell in 1% in January, despite the expectations of an increase. Even so, Japan is tracking the US market and major indices up more than 2%.
Okay, Mike, then why don't we look forwards? What should we be expecting today?
Volkswagen reported already guiding for operating margins of 4 to 5.5%, which the CFO said is not sustainable in the long run. In the US, Oracle, with its earnings, will give an update on AI-related spending. Later on, we also get the US Small Business Optimism Index, offering a read on how US firms are coping with tariffs and geopolitical tensions. And in markets, European equity futures are rebounding, but the US futures are flat after yesterday's gains.
Super. Thank you very much for the update this morning, Mike.
Thank you very much for having me, Bernadette.
And now it's time to talk a bit more about oil with Norbert. Good morning to you, Norbert.
Good morning.
So yesterday, well, it was an exceptional day for oil, wasn't it? As Mike said, prices initially surging beyond 115 in the morning, only to drop below 90 in the evening. What was behind the extreme swings?
Well, it really seemed like the oil market had entered panic mode yesterday. Prices surged in a triple digit as the stress level builds. But to be honest, these moves really keep us somewhat puzzled. Most of it seemed to have come from the sentiment, from the market mood, because we didn't note any tangible, significant shift in fundamentals over the last weekend. The thing is that over these recent years, kind of new markets to trade have been propping up, markets that are open over the weekend. And maybe this was a bit of a spillover from these markets into the more established futures markets.
And have there been any changes in the scenarios that we're currently applying for the continuing conflict?
No, for the time, we leave our probabilities unchanged. So this is more than 60% for the base case of this being a rather short-lived conflict within the month of March, and below 5% for an oil crisis. Yesterday, it seemed that the market really moves rather into this bear case that we see. But looking at price today, it seems as he's already back almost into our base case. The thing is really that you have these concerns in the market about the imminent oil crisis. But the references, I think it's quite noteworthy to look at the references. If you look back at 2022, 2023 energy crisis, the one we still have in memory, this was a very different one because this is a broad kind of post-pandemic shock that really triggered inflation, not only in the energy markets where geopolitics came on top, but really across most of the supply chains, if not all of the supply chains. If you look back at the 1970s, 1980s oil shock, back then it was a very different economy. The dependency on oil was much greater, and you didn't have these buffers, you didn't have these strategic reserves, which were built as a consequence of the shock back then. So maybe the closest reference to the things that we're looking at today, maybe is the Gulf War in the early 90s, 1991, when prices jumped from US dollar 20 to 40, which, interestingly, compared in today's dollars, is more or less an equal move. But I remember back then you had half of Kuwait ablaze, the oil field ablaze, so a serious disruption of oil production, pictures that appeared on TV screens back then that you don't see today.
Okay, and as we heard earlier, governments and especially the US administration seem to be preparing interventions. What could those be?
Well, this is an important element, kind of a new next dynamic of this conflict. They could be comforting ones, such as basically releasing strategic reserves, which, by the way, is really only for the message. If you look back, strategic reserves are basically held to keep supplies if there's a physical interruption somewhere in a country. I'm not that convinced that this really is an element that fundamentally lowers oil prices, but it's a strong message that you give. Of course, it's part of the base case, these elements too, that now countries come together and look at the Strait of Hormuz and look how they could, by safeguarding ships, by securing the shipping lanes, by providing insurance coverage to basically unclog this trade bottleneck. But hopefully there is some learning from previous crises, and we don't see those measures that are harming and that could basically escalate the price reaction or the price shock, which would be something like constricting trade. For example, the United States deciding that they put restrictions on oil product exports, because something like that, of course, would help the states, but it just would complicate things and aggravate the oil shock, the price shock for everyone else in the market. Given the fog of war, which is still kind of out there, we reiterate our neutral views on oil and gas, but we keep our base case in place that this seems to be like a usual geopolitical shock, something short-lived, with prices more or less topping around the levels we have seen over the past days.
Super, Norbert. Very interesting. Thank you so much for joining us today.
Thanks for having me.
Well, that's it for today's podcast. Thank you for listening. And of course, thanks to Mike and Norbert for their input today. Please do tune in again tomorrow when Lucia Ceciulewicz will be here in the studio hosting more of our experts to discuss what's moving markets. So don't miss that. Meanwhile, good luck today and goodbye for now.
The information and opinions expressed in this podcast constitute marketing material and are not the result of independent financial or investment research. Please refer to www.juliusbaer.com/legal/podcasts for further other important legal information.